Hello everybody and welcome to week 13 newsreel. Bogdan here. I hope that you are all doing great and skipping the lengthy intros. I'll cut to the chase here and begin with the quiz question for this week, and it goes like this. To whom did Botswana exported the most in 2020 in terms of value? And the options here are the United Arab Emirates, India or South Africa. And the correct answer is the United Arab Emirates with some $917 million worth of export, guys. All of them representing diamond exports, which basically legitimates even more Dubai's role as a pole for diamond trading and cutting, with all the positive and negatives incurred in this type of trading. But this is another story. Now, moving on to the Freightos index here. Well, for week 13, we had some calm waters, if you want, and it's more or less the same as the previous week, with big movers in the sub-index connecting North America East Coast to China was up 7%, and Europe to South America East Coast was down 3%. In terms of the main sub-indexes here, for the Trans-Pacific head hauls, we have $15,834 for the one connecting China to North America West Coast, and $17,581 for the one connecting China to North America East Coast. For the crossways ones, China to North Europe is down 2%, which brings the value to $12,086, sorry. And for the other one, we're having $13,456, which is down 1% from the previous week. And guys, summing up these main sub-indexes, well, for the United States, it seems that the congestion started to rise in the eastern coast ports as more and more BCOs started to divert their goods from the western coast ports. And for Europe, here we have to consider the context of the uncertainties in Ukraine, high inflation, high energy prices, I don't know, huge freights, and somehow very important pessimistic short-term prospect for the business, which translates naturally into the trading activity of goods and hence the downward pressure on the freight price. I don't think it's just the context here affecting the trading activity, and I'm talking here about Europe, but also a more profound and structural change, if you want, that the importers in Europe are making in relation with their sourcing activities and strategies in Asia. Anyways, we will see if the pressure on the crossways index will dampen or not. There are too many variables here in order to somehow correctly forecast something, and we're entering the realm of speculation. I'm not a big fan of freight speculation, thereby I will move on to my first news. It's an advisory, in fact, coming from Maersk, and it's about the lockdown updates regarding Greater China area. And basically, as I was anticipating last month, terminals in Greater China area main ports remain operational, including vessel operation, yard handling, and gate in, gate out activities. In terms of vessel calls and departure, again, business as usual, while on the land side, the transportation situation is a little bit more dynamic, but it seems that Maersk and most probably other big shipping companies can provide multimodal services via barge or rail services as alternatives for the truck corridor connecting Shanghai to the nearby cities. In terms of the warehouses, at least these operated by Maersk, those in Shanghai are closed from the 28th of March until further notice, while those in Shenzhen, Ningbo, Xiamen, or Qingdao are fully operational. As for the air shipments, only new cargo acceptance will be impacted due to personal constraints. All of this in the context of airlines canceling flights in the coming days, at least for the Shanghai airport, as volumes are expected to be shifted to other airports in China. So basically, guys, as I told you last week, no black swan event here, no huge disruptions as the so-called gurus anticipated. It's more or less business as usual, because don't forget that the Chinese authorities need to keep up the flow of exports up and running. It's simple as that. As I've told you on other occasions, before taking some information for granted, just because he or she is an executive or, I don't know, high-profile supply chain professional, please use your own critical thinking and try to discount the so-called authority arguments, at least in the matters that are important to you. At least that's how I work. Now, moving on to my next news, guys, I have one coming from the US Senate, as the Senate unanimously approved the passage of the Ocean Shipping Reform Act, or OSRA, on the 31st of March. And okay, the bill has currently two versions. The Senate's and the House's, which of course will need to be revised, and I don't know, some differences to be resolved before a single version can go to President Biden for signing. But nonetheless, this is a major step, if you ask me, as the Federal Maritime Commission will have more authority in relation with the shipping lines operating in the United States. And here, guys, I will list a couple of things that most shipping lines will hate. And the first one is the Federal Maritime Commission possible intromission in the business practices of the shipping lines. Another one is to prohibit ocean carriers from declining opportunities for US exports unreasonably. Another thing that the shipping lines will hate, if you ask me, is that these will have to report to the Federal Maritime Commission how many empty containers they are transporting. And la pièce de résistance, if you ask me, is the authorization of the Bureau of Transportation Statistics to collect data on dwell times for chassis in order to study the best practices for chassis management. So, guys, quite a lot of interference here from the Federal Maritime Commission, which the shipping lines most probably hate. Most probably, at the same time, they will invoke some lame excuses to lobby against some of the reforms on the final bill. And by the way, guys, at the time of this recording, the World Shipping Council didn't go public with any statements. But the fact remains that somebody stood against the century-old practice of the shipping lines, and it couldn't be done anywhere else other than the United States, if you ask me, because I don't know, I wouldn't have expected to see this in the European Union, for example, as there are, I don't know, 27 individual interests at game in terms of macro management and strategy. And I'm talking here about the EU member states, of course, with, I don't know, countries like Germany, Spain, Belgium, the Netherlands, Denmark or France, all trying to get what's best for them in terms of, I don't know, either protecting a national carrier or to protect the ports and the terminals they host. So basically, it's harder here to arrive at a common ground, although I won't be surprised to see the EU Commission on Competition to wake up and borrow some of the practices in the Ocean Shipping Reform Act. And guys, speaking of competition authority, I'll move on to my third news. I will be very briefly here. It's coming from containernews.com, and it's about the African Competition Authority, who started an investigation concerning pricing violations by Maersk, CMA CGM and United Africa Feeder Line. More precisely, it seems that the Commission observed that these shipping companies have issued price announcements which may be an infraction of Article 16 of the regulation, which prohibits all agreements which may affect trade between member states and have as their object, or I don't know, effect, the prevention, restriction, or distortion of competition in the common market, end of quote. So guys, another competition authority is scrutinizing the activities of the shipping lines, this time on the African continent, and it seems that it's some kind of jointly planned attack, if you want, by the regulatory authorities all over the world. They do have this momentum, but I will be very, very cautious here, as I don't expect that the World Shipping Council is going to sit still and take all these punches freely. It's just a matter of lobbying, but still I think that things will change in the better in the future, as these outdated business practices in shipping need to be changed. And guys, speaking here about outdated business practices, Evergreen declares a general average on grounded ever forward, which brings me to my next news, again from containernews.com. And basically what general average means is that all the stakeholders involved in a sea adventure proportionately share any losses resulting from a voluntary sacrifice of part of the ship or cargo in order to save the whole in an emergency situation. So the BCOs having their containers on ever forward will have to chip in for the loss, of course, if the general average is not insured by the BCO. But I bet that more than 60% of them don't have their cargo insured. So basically, all cargo owners have to chip in to the loss, as it is a share event, and even if your cargo isn't damaged, a contribution based on the total value of all the ship's cargo must still be made to get your cargo released. So keeping the same analogy here in how all the BCOs have to chip in for the loss, why don't all the BCOs benefit from the successful voyage and split the profits? Let's do, I don't know, how the Venetians did in the 15th or 14th century when they created adventure called Comenda, if I remember correctly, in which all the losses or gains were shared according to their participation. Because guys, if you look at the clauses on the bill of lading, you see a couple of very, very basic responsibilities for the shipping line and a huge list for the BCOs. Come on guys, these mid-17th century practices in shipping have to be changed and, I don't know, somehow aligned to the current environment. I don't know, it's just a thought. And anyways, you know, I'm heavily biased against the shipping lines here. I don't want to get angrier, so I will change subject and move on to my next news. Again, coming from containernews.com. It involves ZIM's new deal in terms of increasing capacity, as it chartered 5,500 TEU new buildings for a period of 7 years, a deal worth approximately $600 million. And guys, we have here a statement from Eli Glickman, who's ZIM CEO, which is about their prudent approach and blah, 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 blah. But if you ask me, and I've looked into ZIM's annual report for 2021, I think that they are just following their usual business model here. And most probably they will deploy these relatively small vessels into the intra-Asian trade zone, including here the Indian subcontinent, eastern coast of Africa, and Australia, of course. As guys, this will be the new growth pole in terms of imports and exports. They've already deployed 6% more capacity in 2021 than they did in 2020. So clearly this trade zone is important for them, both in terms of new growth opportunities or, I don't know, creating value for their shareholders. And guys, without anything else to add there, I've already moved to my last news. Bear with me. It's coming from the EU Commission, as it knocked down the barriers to export of ceramic tiles towards the United Arab Emirates, following a complaint lodged by the European Ceramic Industry Association back in 2020. Which was complaining about the huge red tape in the United Arab Emirates. It was hindering about 75-80% of the EU exports of ceramic tiles. So as from March 31st, EU exporters of ceramic tiles will no longer need to undergo redundant testing or, I don't know, product audits when they export to Saudi Arabia. And guys, with this last news being covered, I don't want to bother you any longer. Thank you all for watching. I really hope that you've enjoyed it. Don't forget to hit those tiny little buttons below this video. And as usual, until next time, keep your business safe. Thanks.